Hello and great welcome. So in this session, we are starting a chapter regarding which you are already familiar with and you have done it so often in the past in your earlier phases of education. So admission of partner, yes, I'm talking about. So it's quite easy chapter. Since you have done it, as I told you earlier, a moment ago, so this particular chapter is not going to pose you any problem because you are already well aware of this particular fact that how the accounting is going to unfold under admission of a partner. But still, as we have a habit of starting any chapter with right from the scratches, so we will love to start even this particular chapter with the scratches. I'm not casting any doubts over your abilities or any aspirations over your what we call skills. I know that you are very well aware of the accounting aspects of this particular chapter, but in spite of that, as I told you, we are going to start from the scratches. So in this particular session, we will try to recap whatever we have done in our earlier phases of education. Correct? As you know, at the time of admission, several adjustments need to be done, and one among them was with respect to profit sharing ratio. So first we will talk about profit sharing ratio, and one by one we are going to pick up the later one. Profit sharing ratio. This is the first one. Profit sharing ratio. When a new partner will come into the firm or when a new partner will be admitted as a partner, quite obviously some adjustment need to be done with respect to profit sharing ratio. Profit sharing ratio. Generally, we come across three types of situation while computing the new profit sharing ratio. So we can say the first situation is like this. Situation A. When only old and new partners, when only old and new partners, profit sharing ratios are given. When only old and new partners profit sharing ratio, PSR stands for profit sharing ratio, are given and no further information is given, it means first situation is one when we would be given only the profit sharing ratio of the old partner and new profit sharing ratio of the incoming partner. So how we are going to compute what we call profit sharing ratio under such a situation? We take up one example to begin it. Correct? So in order to take the example, here I write example. Let us say in a particular partnership, there are two partners A and B. A and B are partners. In a particular partnership firm, there are two partners A and B. We further presume that their profit sharing ratio presently is 3:2. Profit sharing ratio is 3:2. They admit C. So they have admitted C as a partner. So C has been admitted as a partner for 1/5 share, let us say, for 1/5 share. As you can see in this particular example, only old partners profit sharing ratio is given and new partners profit sharing ratio is given and no further information in this case is given. So if I would ask you to compute the new profit sharing ratio, I am also very sure that within a flick of second you all can compute. But still, as I told you, I have a habit of starting right from the scratches. So we shall start right from the scratches. Correct? In order to compute the profit sharing ratio, what we are supposed to do? As you know, or should I say what you used to do? First of all, you used to pursue the profit of the new firm as 1. Let the profit of the new firm as 1. Let the profit of new firm as 1. This is exactly what you used to do. So new firm's profit is presumed to be 1. Now out of 1, 1/5 share will belong to the new partner, so I will subtract it less C's share. After subtracting the new partner share, because out of 1 share, now 1/5 share will belong to the new partner because he has been admitted for 1/5. So what is the remaining profit? Remaining profit means the profit available for old partners. 1 minus 1/5 remaining profit will be equal to 4/5. So in the new form, we may say that profits available for old partner is equal to 4 by 5. And quite obviously, now they are going to share this profit in their ratio of 3:2. So in order to compute the new profit sharing ratio, the new profit sharing ratio of A will be remaining profit, that is 4 by 5, multiply with the old ratio. What is the old ratio? Old ratio is 3 by 5. So the new profit sharing ratio of A becomes 12 by 25. Correct? Likewise, now if I am going to compute the new profit sharing ratio of B, what I am supposed to do, I will take the remaining profit and I am going to multiply it with the old ratio, that is equal to 2 by 5. So 8 by 25 will become the new profit sharing ratio of A and B. So, and new partner share is 1/5, it is given. Now suppose if I want to convert the denominator into 25, so I will think of a numeric value which can convert after multiplying 5 with 25. Obviously that numeric value will be 5. Correct? So I will multiply it with 5. So I will get now 5 by 25. So we may say that in the new form, profit sharing ratio of A is 12 by 25. Profit sharing ratio of B is 8 by 25. Profit sharing ratio of C is 1 by 5 or 5 by 25. So logically now we can surmise that new profit sharing ratio among all these three partners will be 12:8:5. Correct? So that means if in the question only old partners profit sharing ratios are given and new partners profit sharing ratio is given and no further information is given, then new ratio will be remaining profit into old profit sharing ratio. Now, due to some or other reason, suppose I am interested in finding out sacrificing ratio. Sacrificing ratio. What is sacrificing ratio? As we know, due to admission of a new partner, old partner will lose a part of their profit without an iota of doubt. Because earlier two partners were sharing the profit, now three partners are sharing the profits. So quite obviously, due to admission, old partner will have to lose a part of their share of profit. So in what proportion they are losing out, that is known as sacrificing ratio. In order to compute the sacrificing ratio, what I will have to do from their old ratio, I will have to subtract their new ratio. Suppose if in this particular question, I would ask you, what is the sacrificing ratio of A? As you know, sacrificing ratio is always computed in the context of the existing partner or old partner, you may say so. Now, old profit sharing ratio of A was 3 by 5. And new profit sharing ratio, which we just computed, was 12 by 25. Correct? 12 by 25. So I will subtract 12 by 25 from 3 by 5 to know the amount sacrificed by A. For example, I will take the LCM. LCM will be equal to 25. And 25 gets divided by 5. So 5 into 3 is 15. So I'm going to write here 15. And then of course I'm going to write here 12. So 3 by 12. That means 3 by 12 portion has been lost or sacrificed by A because of admission of new partner. Likewise, if I am going to compute the sacrificing ratio of B, the old ratio of B was 2 by 5 and new ratio as we computed is actually 8 by 25. So I am going to subtract 8 by 25 and as you can see, the LCM will be 25. So 25 gets divided by 5 by 2. Now 2 into 2 is equal to 4. Sacrificing ratio of B is how much? 5 into 2 is equal to 10, and 25 by 25, 1, so that will be 8, so we can say 2 by 12. As you can see, after subtracting the new ratio from the old ratio, we can easily find out the sacrificing ratio. Now, if I am going to ask what is the sacrificing ratio, you will say 3 by 12 is to 2 by 12, or we may say 3 is to 2. You must have noticed one important point, that this sacrificing ratio is equal to the old ratio. So in the examination, in the long question, you can escape from these computation if you are aware of this particular rule. So these are the things which I simply want to bring back to your notice. I know that you have already done all these things, but still, just so that you should not lose out on that, So if in the question only old partners profit sharing ratio is given and only new partners profit sharing ratio is given, point number one, in that case, new profit sharing ratio will be equal to remaining profit into old profit sharing ratio. And in such questions, in such question where only old partners ratios are given and new partner profit sharing ratio is given, under such question, old ratio itself will be the sacrificing ratio. So if you are aware of this particular point, you can escape from all these computations later on. We will see that under different situation, more or less sacrificing ratio, one need not require to compute. Logically, it can be directly arrived at. Is it clear to you? Now, second situation, example 2 or B. Under profit sharing ratio, the first situation I told when only old partner share in profit and new partner's profit sharing ratio is given. Under the second situation, when you will have to write today along with me, when old and new partners, when old and new partners, when old and new partners profit sharing ratios are given, partners profit sharing ratios are given along with information regarding sacrifice made by old partners in favor of incoming partner, in favor of new partner or incoming partner, in favor of new partner. So second situation is a little bit different from the earlier one. In this situation, I have written that old and new partners profit sharing ratio will be given, but besides that, some more information will be given regarding the what we call sacrifice made by the old partners in favor of new partner. Let us say in order to understand this particular point, I take an example. In this example, I presume A and B are partners. A and B are partners. Correct? They are existing partners, old partners. We further presume that their profit sharing ratio is 7:3. That is 7 by 10 and 3 by 10. Let us say C is admitted. In this question, C is admitted. C is admitted, of course, as a partner. C is admitted as a partner. Let us say for 1/3 share. For 1/3 share. For 1/3 share. Which he took. Let us say which he took 2/7 from A, 2/7 from A, and let us say 1/7 from B. 1/7 from B. 1/7 from B. I have written here 1/3. You change it to 1 by 7. In fact, you change it to 3 by 7. Then it will be okay. Correct? Let us say he is admitted for 3/7 share. Otherwise, we will get the figure in points. So I have simply changed it to 3/7 share. Correct? A and B are partners. Their profit sharing ratio is 7:3 and C is admitted as a partner for 3/7 share, which he took 2/7 from A and 1/7 from B. Now, in this question, old partners and new partners profit sharing ratio is given, no doubt about it. But besides that, you are given some more information. The information is that how much A is sacrificing in favor of B, C, and how much B is also sacrificing in favor of C. Because the 3/7 share, which is given to the new partner, it is given in the question, he is taking 2/7 from A and 3/7 and 1/7 from B. So under such circumstances, how to compute the new profit sharing ratio? The point is that in order to compute the new profit sharing ratio, under such circumstances, no rocket science is needed. Correct? You can simply think of the logic. For example, in this particular case, if I want to compute the new profit sharing ratio, I will have to think what was my old ratio and how much out of that I have sacrificed. So quite obviously, whatever I will be left up with, that will be my new ratio. So under this situation, sacrifice. So under such a situation, in order to compute the new ratio, all you have to do is simply subtract the amount sacrificed by the old partners from their old ratio. And whatever will be left, that will be their new ratio. Very simple. Correct? For example, in this particular case, if I am going to compute the what we call new ratio of A, I will think of first of all what was his old ratio. The old ratio is 7/10. And from that, I am going to subtract the amount sacrificed. In this case, it is given that A has given 2/7 share to B. So that means out of 7/10, he has given 2/7 to B. So this is the sacrifice made by A. So now what is left? I will take into account the LCM. The LCM will be equal to 70. So 70 gets divided by 7/7. Now you multiply 7 with 7, that is equal to 49. And similarly, it will be equal to 20. So that means A is left up with 29/70. So that will become the what we call new ratio of A. Likewise, in this case, I can compute the new profit sharing ratio of B. In order to compute the new profit sharing ratio of B, I will take into account his old ratio, that is 3/10. And since it is given in the question that he has sacrificed 1/7 in favor of the incoming partner, I will subtract 1/7, compute the LCM, that will become 70. So that will be equal to 21 and minus 10. So in this case, B is left up with 11/70. So that becomes the new ratio of B. So we can say in this particular case also, it is given that C's ratio is 3/7. It is given 3/7. Because A's ratio is 29/70, B's new ratio is 11/70. I want to convert it into 70. So what I will have to do, I will have to multiply it with 10. Both numerator and denominator. So 30/70. You can say 3/7 is nothing but 30/70. So now I may say that new profit sharing ratio among A, B and C is actually 29/70, 11/70 and 30/70, or in more simple words, that is equal to 29:11. 29:11 is to C. Now suppose if in this particular question, I would ask you how to compute sacrificing ratio. How to compute sacrifice ratio. So sacrificing ratio, I have already told you. Whenever you will compute sacrificing ratio, the formula will remain same. That is old ratio minus new ratio. Through this formula, under any sort of situation, you can find out sacrificing ratio. However, as I told you a moment ago, if we are alert and if we are on our toes, so we can escape from what we call these computational exercise. For example, I need not require to compute by subtracting what we call new ratio from the old ratio. It will unnecessarily consume the time, especially I'm talking about in the long question. So in this case, we can see in this particular case also sacrificing ratio is given. For example, in this particular case, we are given that A has sacrificed 2/7, while B has sacrificed 1/7. So sacrificing ratio in this particular case is 2:1. But in this situation, your sacrificing ratio is already given. Now in this situation, your sacrificing ratio will not match with the old ratio. That will happen only under first situation when only old and new partner share are given. So whenever old and new partner shares are given and some further information will be given, Even in that case, we can directly get the sacrificing ratio, but sacrificing ratio will be different from the old ratio, no doubt about it. In case if you have any problem, you can directly apply this formula and you can also compute sacrificing ratio, correct? Now, third situation under new profit sharing ratio, we can say in this manner: when incoming partners, incoming partner means new partner. When incoming partners profit sharing ratio is not given directly, this is the third situation, is not given directly. So under third situation, you will not be given new partners profit sharing ratio in a straight manner. For example, in the first two situations, we saw that new partners profit sharing ratio was 1/5. In the second situation, it was 3/7. It was given in a straight manner. However, under this situation, new partners profit sharing ratio will not be given in a straight manner. For example, suppose if I take the example, let us say, again I presume A and B are partners and their profit sharing ratio are partners, and their profit sharing ratio is, we further presume, 7:3. Once again, correct? It is given that C is admitted as a partner. C is admitted as a partner Now, C's profit sharing ratio is not given in this question, correct? However, it is given that A surrenders 1/7 of his share and B surrenders let us say 1/3 of his share in favor of C. Now this question sometime, or such sort of situation sometime, students get confused, and unnecessarily they get confused. They think actually this is the second situation. No. Even in this case, and even in the last case, of course, old partners, new partners profit sharing ratios were given. First of all, in the last case, new partners profit sharing ratio was given, and also it was given that how much he is taking from A and how much he is taking from B. However, in this particular question, we are given that A surrenders 1/7 of his share. Now, 1/7 of his share. First of all, I will have to compute how much A is sacrificing, because in this case, it is not given what exactly A is sacrificing, because it is written 1/7 of his share. Similarly, B surrenders 1/7 of his share. So in this question, some fractional surrender is given and not complete sacrifice is given. So how to compute in this particular case new ratio? In order to compute the new ratio, again, I am going to apply the same formula. For example, first of all, I am going to compute A's sacrifice. How much A is sacrificing? A sacrifice. Because it is given A has surrendered 1/7 of his share. So first of all, I will take into account 1/7 of his share. Of his share means 7/10. Now A's old ratio is 7/10 and he is surrendering 1/7 of this. So that means sacrifice made by A is equal to 1/10, because 7 will get cancelled. So now we can say that A has sacrificed 1 by 10. Likewise, it is given in this question, B sacrifice. Now, what will be the B sacrifice? It is given that B has sacrificed 1/3 of his share. Now, his share is 3 by 10. So, 3 will cancel. That means B is also sacrificing 1 by 10. Is it clear to you? Now, we can compute new profit sharing ratio of A and B. Now, new profit sharing ratio of A, now we can use the second method formula. The old ratio is 7 by 10. And now I have computed the sacrifice made. So, sacrifice made is 1 by 10. So, that will be equal to 6 by 10. And if I want to short it, it will be equal to 3 by 5. So, this is the new profit sharing ratio of A. Correct? Now, similarly, you can compute the new profit sharing ratio of B from the old ratio. You can subtract the sacrifice made by him. So that will be equal to 2 by 10 because this is what B is left off with. This is the new ratio of B. And if you want to short it down, it will be equal to 1 by 5. Now, problem is that, what is the new ratio of C? It is very simple. Whatever A is sacrificing, whatever B is sacrificing, you simply add it because that will be received by C. Now, in this question, A has sacrificed 1 by 10 and B has also sacrificed 1 by 10. So, that means the new ratio of C will be equal to 2 by 10. So, that is equal to 1 by 5. So, we may say in this particular case, new ratio among all these three partners is equal to 3:1:1. Now, suppose in this particular case, I would ask you what is the sacrificing ratio. Actually, I have already told you, at any point of time, under any situation, sacrificing ratio always remains same, old ratio minus new ratio. You can compute it that way round. But if you want to avoid the calculations, you have to be a bit alert. Now, in this question, it is given that A has sacrificed 1 by 10. Rather, we have computed it. And B has also sacrificed 1 by 10. So, even in this situation, we can say that we can directly arrive over sacrificing ratio. We will see the importance of sacrificing ratio later on. Is it clear to you or not? So, generally, we confront three types of situation. Generally, we confront three types of situation for calculating profit. And you must have noticed, among all these three situations, logically, we need not require to compute sacrificing ratio, correct? So we can avoid the computations of sacrificing ratio, rather, I should say that way around, because in the first case, old ratio will be the sacrificing ratio itself. In the second case, also sacrificing ratio is given. And in the third case, sacrifice made by A and B can be found out very easily because that will also be given in the question. So, However, when you will have to use the formula only, or should I say when without using formula you cannot get sacrificing ratio. Such a situation may arise if, suppose in the question it is given, A and B are partnered, their ratio is 3:2, and C is admitted and new profit sharing ratio is, let us say, 3:2:2. So whenever old and new ratios are given, in that case, you will have to apply formula only to compute the sacrificing ratio. You cannot get straight away sacrificing ratio. This is the only situation when you will have to use the formula to compute the sacrificing ratio. Is it clear to you? Now, as you must have noticed in your earlier phases of education, when a new partner comes into the firm, he is asked to bring some extra amount, correct? And that is known as goodwill. So first of all, let me write topic 2, that is valuation of goodwill. Valuation of goodwill. First of all, you need to understand why there is need for valuation of goodwill and how we compute the goodwill. There are different methods for computing the goodwill. We'll talk about it later. But I would love you to know now why there is need for valuation of goodwill in case of admission of a partner. Try to understand this. Suppose there are two partners A and B, and they have got an established firm, and let us say they are in the trade since last, let us say, almost 20 years or 25 years. Let us say since a pretty long period of time they are in the trade. They have got very good goodwill, very good reputation, and their firm is earning heavy amount of profits also. Let us say their profit sharing ratio is 3:2, and because of their expansion plans, let us say they felt the need to admit a new partner. Correct? So a new partner is admitted into their firm, and as per the agreement, he was asked some terms and conditions will be set before the new partner will be admitted, quite obviously. Let us say in their meeting, A and B asked the new partner, in fact told the new partner that we are going to give you 1/5 share of profit, number one. And second point is that you will have to bring, let us say 20 lakhs as amount of capital. You will be given 1/5 share of profits, but in order to join our firm, you will have to bring, let us say 20 lakh worth of capital. The moment A and B tossed this particular point in front of C, for a while C thought for a moment. He thought for a moment and he thought that if I would have started this business, or if I would start this business all along, then I may require a very huge amount of investment, let us say almost 100 lakhs, to establish the same sort of spanky office. Correct? So I may have to invest nearly 100 lakhs. And here I am simply being asked to contribute rupees 20 lakh as capital, and also I am being given as 1/5 share of profit. So it is not a losing position for me. So C thought for a while and then he said, okay, fine, these terms are acceptable to me. So A and B told C that you will be given 1/5 share of profit, and we would love you to bring or contribute 20 lakh as capital. Once these conditions are accepted by C, now A and B tell Mr. C that you are joining an established firm. Mr. C says, oh, of course, sir, I am joining an established firm. Now A and B also tell Mr. C that if you would have started the business all along, first of all, you may had to invest a very heavy amount, number one. Second, there was no assurity that right from the beginning you will have the profits. Mr. C says, yes, sir, you are absolutely right. So A and B tells to C that by joining an established firm, you are assuring yourself that right from the beginning you will have some share of profits, that is 1/5 profit every year. Correct? And you need not require to nurse any fear that you will not have the profits right from the word go. Right from the first year, you will have the profits because you are joining an established firm. C says, sir, right. I am able to understand what you are trying to say. Now, A and B stretch the discussion a bit further. Now, A and B tell Mr. C, directly or indirectly, what we are trying to tell you is that we have three conditions. One is that we are going to give you 1/5 share of profit. This is acceptable to you. And we are asking you to bring 20 lakh capital. This term is also acceptable to you. Now, next point is that we would love you to contribute 10 lakh rupees, some extra amount. 10 lakh rupees, some extra amount. Also, now here, C, who is a very young person, let us say, correct? Suddenly he raises a question. So first of all, why I should contribute besides 20 lakh, 10 lakh, some extra amount? Now A and B tell to Mr. C, the discussion which we are having with you is that we are in the trade since a long period of time. We have a great reputation, and You are assured of this particular fact that right from the beginning, you are going to have the profit. And remember, if you had started the business all along, there was no surety that right from the word go, you are going to have the profit. Especially in the initial years, you may have to actually bear some losses. So by joining an established firm, you are taking this advantage of this particular fact that you need not require to worry about what we call losses. That is the reason we are asking you to compensate us, and also A and B tell Mr. C. And don't forget, Mr. C, that by joining our firm, we are losing a part of our share of profit. Because you are joining our firm, so we are losing a part of what we call our share of profit also. So we would love you to compensate for that, and the amount will be 10 lakh. This extra amount which is demanded from new partner in technical language is called as goodwill. Sometimes it is also called as premium amount. Is it clear to you or not? So what is goodwill? Many a time, student, whenever word goodwill is asked, a student only think of reputation, correct, prestige, or something like this. But when I say in case of admission, whenever we will talk about the goodwill brought in by the new partner, so what is the amount of goodwill here? Goodwill means new partner is asking old partners are asking the new partner to compensate the old partner for the sacrifice made by them. Correct? And that compensation is known as goodwill. Now problem here is that C tells to A and B, sir, I have accepted your every point. I am ready to bring this extra amount also. But I would love to know on what basis you are asking me to bring 10 lakh as extra amount. Why not it is 8 lakh? Why not is it 5 lakh? Why not it is 7 lakh? Why you told me to bring 10 lakh? Now A and B knew through their experience that Mr. C could ask this particular question. So they tell to Mr. C, actually our firm's goodwill is 50 lakh worth. Our firm's goodwill is near about 50 lakh and your share is 1 by 5. So we are asking you to contribute 10 lakh. Now C says, sir, could you prove me how your firm's goodwill is worth 50 lakh? So when a new partner comes into the partnership, sometime he may force the old partners to prove that their firm's goodwill is this much. And in order to prove that, old partner will need the different methods of valuation of goodwill to prove to the new partner that our firm's goodwill is this much. So point here, when I say valuation of goodwill, I am trying to actually hammer into your mind why there is need for valuation of goodwill. I hope you got a fair bit of idea now actually why there is valuation of goodwill. Just to satisfy the curiosity of the incoming partner that our firm's goodwill is this much and your share is this much. In order to assure him, we need valuation of goodwill. Is it clear to you or not? So you must have noticed this is an interesting point and sometimes we skip it out, but you should be aware of all these. Is it clear to you? Okay then. So if that point is clear to you, now we come over to the next point or the main point. Valuation of goodwill. There are three methods to value the goodwill. One is known as average profit method. And this is the most simplest method and most popular method. Average profit method. Correct? Average profits method. One method is average profits method and you have already done it so many times as I told you earlier. Next method is known as super profits method. Another method is known as capitalization method. So there are basically or broadly three methods of computation of goodwill. Correct? One, as I told you, that is average profit method, and then we have super profits method, and then we have capitalization method. Generally, we come across three sort of method. Just to recap the things, I know that you are very well aware of all these things. So, under average profit method, how to compute the goodwill, each one of you are very well aware of it. Average profit method. Under average profit method, what you used to do in order to compute the goodwill, first of all, you used to take into account the average profits, correct? This is what you used to do, average profits. Then all you have to do, or all you had to do, is to just multiply it with years of purchase. You used to multiply it with years of purchase. Years of purchase to get the amount of goodwill. So under average profit method, we need only what we call two steps. Computation of average profit and simply multiply it with years of purchase. Is it clear to you? Besides that, there was a method known as super profits method. Super profits method. Under super profits method, how you used to compute the amount of goodwill? Under super profits method, if you remember, first of all, you used to take into account your actual profits or average profits. Actual or average profits. Actual or average profits. Correct? This is how you used to compute the amount of goodwill, actual or average profits. Correct? And then from it, you used to subtract less B, normal profits. You used to subtract normal profits. In order to compute the normal profits, what you used to do, in order to compute the normal profit, you used to multiply capital employed with normal rate of return. And because normal rate of return is generally given in percentage, so capital employed into normal rate of return divided by 100. So that 100 will automatically come into play, don't worry about. So this is how you used to compute the normal profit. After having computed the normal profit, what you used to do, you used to get super profits. The difference between the actual or average profits and normal profits is your super profits. This is how you used to compute super profits. Is it clear to you? Then in this case, we used to multiply super profits with years of purchase. With years of purchase. With years of purchase. To get the amount of goodwill. To get the amount of goodwill. This is how we used to compute the amount of goodwill. Just to make little bit elaboration in this particular case. Correct? Suppose there is an entity Suppose there is a partnership firm of A and B. A and B, partnership firm of A and B is there, and capital employed of A and B, let us say, is equal to 8 lakhs. This is the capital employed of A and B. We further presume that average profits of A and B, average profits means per year actual profits. So average profit, on an average, every year, let us say A and B are earning profits of rupees 1 lakh. 1 lakh. Correct? We further presume that normal rate of return is 10%. Normal rate of return is 10%. Let us say in this case, I need to compute the amount of goodwill. At 3 years purchase of super profits. 3 years purchase of super profits. So how I am going to get the amount of goodwill? Very easy. I just told you under super profits method, actually what we are supposed to do. Just a moment ago I told you, here first of all I will have to write average profit or actual profit, whatever given in the question. In this case, average profits are given. So average profit itself means actual profits. That means actual profits of A and B are 1 lakh. Then from this profit, we are going to subtract the normal profit. And in order to get the normal profits, we need to have the capital employed. When we say capital employed, it means capital employed of existing partner. Now capital employed of existing partner is 8 lakh. And normal rate of return is 10%. Now what we mean by normal rate of return? Do you know, you have heard about industry. What is an industry? Let us say I am talking about computer industry. So what we mean by computer industry? It means all the firms which are manufacturing computers or dealing in computer will fall under this industry. Industry is a collection of firms which are engaged in the same line of trade. We presume that firm of A and B deals in computers only. So we may say that A and B belongs to computer industry. And when I say normal rate of return is 10%, what we mean by normal rate of return? That means in this industry, normally profits are equal to 10 against a capital of 100. When we say normal rate of return is 10, that means by investing rupees 100, we get a profit of 10 in this industry. Is it clear to you? So, what is the normal profit? So, normal profit is that on an investment of 100, I will get only 10. Suppose if I am going to invest 8 lakh, how much profit I will get? That is equal to 8 lakh into 10 by 100. So, normal profit means normally in this industry, people get 10% of their investment. So, suppose investment is 8 lakh into 10%, we will get only 80,000 worth of profit. So, normal profit, basically what normal profit suggests? The normal profit suggests that normally in this industry, on a capital of 8 lakh, the firms will earn a profit of 80,000. But on 8 lakh, because our capital employed is 8 lakh, but on 8 lakh, we are earning a profit of 1 lakh. Are you getting my point or not? So that is why we are superior to other firms, and that is why the difference of these two is known as super profits. So super profits is 20,000. Now I am going to multiply it with years of purchase. Years of purchase. What is years of purchase? What is years of purchase? When A and B tell C that we are going to compute the goodwill at 3 years purchase, 4 years purchase, or say 5 years purchase, what does it mean? It means, suppose A and B are telling to C that we are going to compute the goodwill at 3 years of purchase, it means they are telling to Mr. C that you would have required 3 years period, you would have required at least 3 years period to acquire the same sort of goodwill, reputation and profits which we are earning presently if you would have started the business all alone. If you had started the business all alone, at least 3 years period of time you would have required to earn the same sort of goodwill, profits or reputation which we are earning presently. That is what we mean by years of purchase. So 60,000 in this case will be your goodwill. You have done it so many times, but I'm trying to make you understand the logic also. So under super profits method, this is how you use to compute the amount of goodwill. Now, besides that, there is a third method also, correct? Now, third method is known as capitalization method, as I told you. Capitalization method. Capitalization method. Under capitalization method, how to compute the amount of goodwill? Under capitalization method, first of all, what I am supposed to do, I need to compute the capitalized value. Capitalized value. Capitalized value. Normally, formula for computing capitalized value is actual profit or average profit divided by normal rate of return. Divided by normal rate of return. This is how you are going to compute the capitalized value. Once you have computed the capitalized value, then you are going to subtract from it the actual capital employed. Actual capital employed. Actual capital employed. Actual capital employed. Correct? Then the difference of these two will give you what we call goodwill. For example, if I will take this case and I will compute the amount of goodwill, let us say on capitalization basis. So how I would compute? I told you, first of all, I am going to compute the capitalized value. What is capitalized value? I will let you know in a short while. But as we saw that our actual profits were 1 lakh in the previous example, and normal rate of return is 10%, so 10 by 100. Now, if I am going to solve it, my capitalized value will be equal to 10 lakh. My capitalized value will be equal to 10 lakh. But you will not be able to understand the meaning of capitalized value. First, let me explain it. Normal rate of return, I have already told you. What does it indicate? Normal rate of return 10%. What does this 10% indicates? It indicates that investment means capital employed. If I am going to put up a capital of, let us say, 100 in this line of industry, then I will be able to earn a profit of 10. That is what we mean by normal rate of return. Now put it in other words. In other words, it means in order to get a profit of 10, I will have to invest, that is 100 rupees to get a profit of rupees 10, because normal rate of return is 10. In order to earn a profit of 10, I will have to put up, in order to earn profit of rupees 10, I will have to put up a capital of rupees 100. This is what we mean by normal rate of return. Now, because our firm's profit is equal to 1 lakh, for a profit of 10, capital requirement is 100. For a profit of 1 lakh, what is the capital requirement? 1 lakh into 100 divided by 10, that is equal to 10 lakh. You can see this is nothing but capitalized value. Now, what is capitalized value? Capitalized value means because your firm is earning a profit of 1 lakh. So this value, what does it suggest? That means other firms in the market will require a capital of 10 lakh to get a profit of 1 lakh. Other firms in the market would require a capital of 10 lakh to get a profit of 1 lakh. But how much is your capital? You are earning this 1 lakh worth of profit only by employing 8 lakh as capital, because your capital employed is 8 lakh. You are earning a profit of 1 lakh on a capital of 8 lakh, while other firms would require 10 lakh to get the same amount of profit. So what is capitalized value? Capitalized value means market value of your capital. Actually, your capital is 8 lakh, but it is equal to what we call 10 lakh because other firms in the market will require 10 lakh worth of capital to attain the same amount of profit which your firms is earning presently right now. Is it clear to you or not? This is what we mean by capitalized value. You have done it so often in the past, but none of you are actually very well aware of this particular meaning. That's the main reason I'm doing it. So this is capitalized value. Capitalized value means market value of your capital. Now this is the market value of your capital. Now you will subtract the actual capital employed. So your actual capital employed, you know already. Your actual capital employed is 8 lakh. Your actual capital employed is 8 lakh. So the difference will tell you goodwill. Generally under this method, no years of purchase required. So basically these are the three methods, and it is up to the old partners by adopting any of these three methods, they can prove that their firm's goodwill is equal to this much. Further, let me also explain one important point. You under capitalization method, you can compute the amount of goodwill in this manner also. Simply you can divide super profits by normal rate of return. You will get the same answer. Because we have already solved this question earlier. So we got the super profits. What was the amount of super profits when we earlier computed 20,000? Super profits were 20,000. If I am going to divide 20,000 by 10%, I can still get the same answer. Is it clear to you? I can still get the same answer. So capitalization method, you can use this method or this way around, but you are going to get the what we call same result as I just told you. Another important point is what we mean by capital employed. So often we are using this word capital employed. In order to compute the capital employed, it is very important for you to understand that when we compute the capital employed, obviously in order to compute the capital employed, we will take into account assets. And from there on, I am going to subtract the liabilities. to get the amount of capital employed. Is it clear to you? Now, it is also important to understand that when you will consider asset, because we are computing capital employed for the purpose of goodwill, correct? For the purpose of goodwill. So, whenever you are going to compute capital employed, generally 99% it will be given in the question. But in rare cases, correct, you may have to compute capital employed. So, you must know that following assets will not be considered. Following assets shall not be considered. That means you will not take them into account for computing capital employed for the purpose of goodwill. Following assets shall not be considered. You will simply ignore them out. What are those assets? For example, A, valueless asset. Valueless assets. Now you may ask, sir, what are valueless assets? Valueless assets such as deferred expenditure. Sometime on the asset side you must have seen deferred expenditure. So deferred expenditure generally gets reflected on the asset side because this item is not yet written off. It is still having a debit balance. That is why it is appearing on the asset side. Otherwise, it is not an asset because it is not going to fetch any return to us. So that is why deferred asset or deferred expenses you will not take into account when you will compute the assets. Deferred expenses, or sometime it is written miscellaneous expenses, you will not consider. Correct? B, debit balance of profit and loss account. In case if on the asset side you have debit balance of profit and loss account, you will not consider it. Is it clear to you? Similarly, non-trading investment. You will never ever consider non-trading investment for the purpose of capital employed in connection with goodwill. Because we are valuing goodwill, for the purpose of goodwill we are computing capital employed, and we will not take into account non-trading investments. Now the main question is how you will come to know that investments are non-trading. Suppose this is the balance sheet of a particular company. Suppose this is the balance sheet of a particular company. And on the balance sheet, let us say word investment is written. Investment is written, let us say, you can think of any amount. Now you tell me whether it is investment or this investment is trading or non-trading. Remember one thing, every investment in the balance sheet is always considered as non-trading. Is always considered as non-trading. Why it is considered non-trading? Investment means our entity has invested or our firm has invested some amount in shares or bonds or debentures of other entity. So that means the amount which we have invested in other entity, logically our funds are being utilized by other entity. Because when I am going to make some investment in other entity, I will have to actually provide funds to that particular entity to get their shares or debenture, isn't it? So that means my funds are being utilized by other entities. So we are not utilizing these funds. So that is why they are considered as non-trading. Investments in balance sheet are always non-trading. You have to understand this. Number one. Number two, you need to understand that when investment could be trading. Investment could be trading, suppose, just wait. Suppose, what is happening? Suppose in the balance sheet, now this is another situation. In the balance sheet, word investment is written. Word investment is written. And in bracket it is written for replacement of, let us say plant, or it is written for redemption of debentures. If in the bracket it is written replacement of plant or any asset, or redemption of debenture, then you will consider investment as trading investment. Then you will consider investment as trading investment. Is it clear to you? So non-trading investment you will never ever consider for computing capital employed for the purpose of goodwill. Is it clear to you or not? Secondly, you will also not include any work in progress or assets under construction. Assets under construction. You will never ever include such assets. Why? Because these assets are still under construction or work in progress. They are not yet completed. So that means we are not using these assets right now, or we are not in a position. That is why you will ignore them also. You will also not include any asset held for sale. Asset held for sale. Asset held for sale. Suppose in the balance sheet it is written land for the purpose of sale or plot of land for the purpose of sale. That means here the intention of the entity is not to use that plot of land, rather to sell it. So such assets will not be included. And very important, in the balance sheet, if there is any goodwill, you will also not consider that simply because you are valuing the goodwill. So in order to compute capital employed, generally we will never ever feel the need for computing the capital employed. On a rarest of situation, let us say we presume that we are supposed to compute capital employed, then how it is done? Just I wanted to give you an idea. Is it clear to you or not? Is it clear? Now, after having done all these things, now the next point is you also need to learn the art of computing future maintainable profits. Now, what we mean by this future maintainable profit? future maintainable profit. Future maintainable profit. Future maintainable profit. How to compute future maintainable profits? Better known as FMP, and why we are computing it. Future maintainable profits, what does it mean? Just to make you understand a wee bit. Let us say there is partnership firm of A and B, and profits of year 1 are this much, profits of year 2 is equal to this much, and profits of year 3 is equal to this much. Let us say I have total these profits, so I will get the total profits. Now suppose at the time of valuation of goodwill, when old partners and new partners, correct? When old partners and new partners will value the goodwill, in that case, we will have to do some adjustment to the total profits. What sort of that adjustment? For example, if there are any abnormal losses, I will have to add those losses. For example, A and B tell to Mr. C that in year 2 we have suffered a loss, but that is abnormal. Abnormal losses means it is not going to take place regularly. So if we are going to exercise care and caution, we can stop such losses from taking place in future. So that is why abnormal losses are always added back. At the same time, if there will be some abnormal profits, then those abnormal profits must be subtracted. Correct? Suppose in a particular year, there are some abnormal profits, the new partner may say that this particular year's profits are high because of some abnormal circumstances. So let us deduct the same. Similarly, if there is some non-operating income. Non-operating income means income which is coming to us not because of sale of product or services, rather because of something else. For example, our entity has invested in some other entity and we have received some dividend, and we have included that dividend in the profit. So it is a non-trading income. It is a non-operating income. So that will be subtracted. That means whatever profits you are given sometime, I'm not telling that you may need such things, but in case if you would need or some such adjustment arrive, then you should be aware of all these things. So by totaling up the profits, first of all, you add and then subtract these two adjustments to get total adjusted profit. It will be known as total adjusted profit. It will be known as total adjusted profit. Is it clear to you or not? Now, in this case, I have considered 3 years of profit. So, after having arrived over total adjusted profit, I will divide it by the number of years, that is 3 in this particular case. After dividing it by 3, I will get average adjusted profit. So, what we mean by average adjusted profit? Average adjusted profit, in simple words, average profit of the past years, correct? After considering only normal circumstances. You can see we have already eliminated the abnormal things. So that is why average adjusted profit simply reflects that in the past, per year, how much profit our entity earned under normal circumstances. So after computing the average adjusted profit, sometime I may have to add future gains. Suppose if in future some gains are there, some possible gains are there, then we will have to add it. Let us say new partner is a technocrat, and not technocrat, he is a technical expert. So let us say due to his induction, we may actually reduce the staff. So there may be some savings in the salary. So it is a future gain, such gain will be added. Similarly, if there will be any future losses, for example, new partner who is a technical expert, as I told you, let us say he may demand that some new computers, some high-profile machineries, computer, etc. must be established. So it will give rise to some future expenses. So in case if there are some future expenses or losses, we will subtract the same. Then we will get future maintainable profit. So future maintainable profit is nothing but your actual profit or average profit only, but it means how much our entity will maintain the profits in future after considering the normal circumstances. And why we need these profit, why we need future maintainable profits. Sometime question may ask you to compute the future maintainable profits, then you should be in a position to compute it. Now after this, we are moving over to the next topic. The next topic is topic number 4. Topic 4. In this particular topic, we will talk about treatment of goodwill. Treatment of goodwill. Treatment of goodwill. Under this particular topic, we are going to talk about treatment of goodwill. When we say treatment of goodwill, what does it mean? As I told you a moment ago, when a new partner is admitted, he is asked to bring his share of goodwill. So how we are going to treat it under accounts, the point is this. So there are generally two broad situations for treating the amount of goodwill. There are generally, as I told you, two broad situations for treatment of goodwill. That is, when new partner brings his share of goodwill in cash and when new partner fails to bring his share of goodwill in cash. So basically, treatment of goodwill is divided into two parts, as I told you. One, A, that is, when new partner brings his share of goodwill in cash, brings his share of goodwill in cash. This is one situation. So generally new partner is able to bring his share of goodwill, but under some circumstances he might not be able to. So this is situation 2, when new partner fails to bring his share of goodwill in cash. So these are the two situations, and we will talk about these two situations after a break of what we call, let us say, 10 minutes, correct? After that, we will recontinue. So till then, you also take some break, and after that, we will continue. So welcome again to this particular session. So now we will analyze when new partner brings a share of goodwill in cash. Even under this situation, two further situation may unfold. For example, amount retained. It means amount of goodwill retained. Amount of goodwill retained. Situation 1. And under it, when new partner brings his share of goodwill in cash, second situation is amount of goodwill is withdrawn. Amount of goodwill is withdrawn. Amount of goodwill is withdrawn. Correct? So when new partners bring his share of goodwill in cash and that amount is retained, the entry which we are going to pass will be like this. What entry you are going to pass? Your entry will be A. Cash account debit. Cash account debit. 2. Premium for goodwill account. Premium for goodwill account. Now it's a pretty long word, so I will write PFGW, premium for goodwill account. Correct? Let us say new partner is bringing his share of goodwill 1 lakh. So entry will be cash account debit 1 lakh to premium for goodwill 1 lakh. I have already told you that new partner brings goodwill and that he brings that goodwill to compensate the old partner because due to his admission, old partners have lost out a part of their share of profit. So whatever premium is brought in, premium is goodwill, whatever premium for goodwill brought in by new partner, that will be credited to the old partner in their sacrificing ratio. Correct? So next entry under this will be, that is premium for goodwill account debit. Premium for goodwill account debit. Whatever goodwill he will bring, that will be credited to old partner account. Let us say old partners are A and B. So I will write A's capital account and B's capital account. Correct? And this will be credited in sacrificing ratio. In this case, we will pass only these two entry. Correct? And this case is known as amount of goodwill is retained in the business. When new partner brings his share of goodwill in cash and amount of goodwill is withdrawn, then we will pass the same entry. First, cash account debit to premium for goodwill account. Then whatever premium has been brought in, that will be credited to the old partner. After this, we will pass another entry. What will be the entry? A's capital account debit. That means when amount of goodwill is withdrawn, besides these two entries, we will have to pass another entry. A's capital account debit. B's capital account debit to cash account. So here, the cash new partner which he has brought in, now old partners have withdrawn it. So we will write here to cash. So that is why in this case, besides these two entry, we are going to pass this entry. Is it clear to you or not? Now there is another situation when new partner fails to bring his share of goodwill. Let us say new partner's share of goodwill is 1 lakh, but he fails to bring it. Because he is not bringing any goodwill, so we cannot pass this entry cash account debit to premium for goodwill. But problem is that credit must be given to old partner for the what we call goodwill. The point is this. So in this case, new partner is not bringing his share of goodwill, but still the credit will be given to old partner. So your entry will be C's current account debit. We will debit C's current account. Correct? We will debit C's current account with his share of goodwill. And we will credit A and B in their sacrificing ratio. So when new partner does not bring his share of goodwill in cash, even in that case, C's A and B will get credit, and of course in sacrificing ratio, and C's current account will be debited, and whenever in future he will bring his share of goodwill, at that time we will pass the entry cash account debit to C's current account. So generally such sort of scenario exists. Correct? In case of goodwill. Just to make you understand better, we will pick up some example to make you understand. Example. Let us say in this case, it is given in the question that A and B are partners. A and B are partners. And profit sharing ratio is 7:3. Profit sharing ratio is 7:3. We further presume that C is admitted. Let us say for 3/7 share. 3/7 share. Which he took 2/7 from A and 1/7 from B. 1/7 from B. Let us say it is given that C's share of goodwill is estimated at rupees, let us say 30,000, at rupees 30,000. And let us say it is written that C could bring only rupees 10,000 in cash. Rupees 10,000 in cash. His share of goodwill is estimated at rupees 30,000, but he could bring only 10,000 in cash. So in this case, how we are going to deal? As you know, C's share of goodwill is already estimated at 30,000. C's share of goodwill is how much? That is equal to 30,000. 30,000 is share of C's share of goodwill. How much he is brings in? He brings in, out of 30,000, he brings in 15,000 and does not brings in 15,000. Does not brings in 15,000. This is the situation. So, in this case, the portion which he is bringing in cash, correct? You are going to apply the rules which I just mentioned when he brings his share of goodwill in cash. So that means he is bringing his share of goodwill in cash 15,000. So I will write the entry cash account debit. I will write the entry cash account debit 15,000. Correct? I am going to write 15,000. Is it clear to you? And I will write here premium for goodwill account. Premium for goodwill account in short form I have written 15,000. The moment you are going to pass this entry, immediately you must credit the amount of premium to the old partner. So next entry will be premium for goodwill account debit 15,000 to old partners account. Old partners are A and B. And this goodwill must be credited in sacrificing ratio. In this question, it is given that A is sacrificing 2/7 and B is sacrificing 1/7 in favor of C. So sacrificing ratio is 2:1. So 10,000 and 5,000. If it would have been written that A and B have withdrawn their amount of goodwill, then I would have passed another entry, A account debit, B account debit to cash, but it is not written. If it is not written, we will always presume that this amount is retained. Now the portion which he could not bring in that case, I told you we cannot pass this entry, cash account debit to premium, because he is not bringing in 15,000 balance of his share. So for this, we are going to debit his current account. C's current account debit. We are going to debit his current account. It is better to debit the current account. Sometimes other authors actually, they debit the capital account also. But it is better to debit the current account. So we will debit his current account by 15,000. This portion he could not bring in cash, and still we are going to credit it to A's capital account and to B's capital account in their sacrificing ratio, 10,000, 5,000. Is it clear to you or not? Is it clear? 100% it is clear? That is fine. So once you have completed this one, so now after having completed till up to this particular point, now we are in a situation to move to the next level. Is it clear to you? So we are finishing up this particular session here, but we will continue in the next session. Is it clear to you with something new as usual? So shall meet you in the next session then.